Konnichiwa and Salam Alaikum. In this week's markets, we've seen a good rally on the ADX and the DFM indexes, driven by new liquidity and volume in the second half of Ramadan, particularly for large cap liquid stocks such as MR, LDAR, DFM and Arab Tech. In the case of LDAR, DFM and Arab Tech, it is no coincidence that these have rallied so strongly, given the fundamental strength of each of these companies and the fact that they've been trading on such low PE multiples and have a higher quality of earnings in general than other companies in the UAE. In corporate news this week, DP World, listed on the Nasdaq Dubai, has entered into a partnership with Brazilian company Odebrecht to acquire a majority stake in Brazilian ports terminal company, otherwise known as Embraport. The fully developed facility, located just outside Sao Paulo, will have capacity of around 1.5 million TEUs by 2015 and handle around 2 billion litres of ethanol. The port expands DP World's foothold in the growing South American region, in addition to its recent investments in Peru, and gives it particular exposure to the high-growth Brazilian ethanol industry. We maintain an overweight recommendation on DP World and a price target of 48 cents per share. It has recently rallied up to 43 and 44 cents per share following a result above expectations, and we believe that investors who bought at lower levels can consider taking some short-term profits, but those with a longer-term horizon should increase their holdings in DP World for a 12 or 18-month holding period. This week we have initiated coverage of research on two core companies in the UAE, including First Gulf Bank and Arab Tech. For First Gulf Bank, we have an overweight recommendation and a price target of 19.38 dirhams per share. First Gulf trades on a low PE of 6.509 earnings, at a significant discount to the peer average. We believe that it deserves a PE premium to peers and a higher share price based on its high market share in Abu Dhabi, a low cost to income ratio, good net interest margins, diversified loan book exposure across sectors, and also a non-interest earning capacity equivalent to 32% of net income for our forecast 2009 period. First Gulf Bank also has a high shareholding from the Abu Dhabi ruling family, and over 70% of its customers are local Emiratis, of which 90% of them are employed in government institutions, meaning that investing in First Gulf Bank gives exposure to the Abu Dhabi government and the growth of Abu Dhabi, and a higher credit portfolio quality than many other banks listed in the UAE. For construction company Arab Tech, listed on the DFM, we have a price target of 4.18 dirhams per share and an overweight recommendation. Although the construction cycle is yet to bottom out in the UAE, Arab Tech's project backlog has been fully pared back, with many of the unrealistic and underfunded projects being cancelled, and the project backlog now is a lot more sustainable and has potential upside should Russian conglomerate Gazprom choose to go ahead with its 10 billion dirham site in St. Petersburg, Russia, which would add around 37% to our earnings per share forecast for Arab Tech over the next 2 to 3 years. Receivables during the second quarter actually improved, and they are now owed 4 billion dirhams from developer clients across a mix of private sector and public clients. We think that the second tranche of Dubai's 10 billion US dollar bond will help release cash flow to government-related entities, who can then pay Arab Tech outstanding funds and improve the company's working capital position and improve the stock valuation. The company trades on a forward PE of around 5 times, meaning that any potential further downside to earnings is already factored into the share price, and therefore we think there is strong upside in Arab Tech over a 12-month period, with key catalysts being the outcome of the Maidan dispute, the Russian Gazprom issue, and also the fact that Arabtech trades on such a deep discount to industry peers, around 73%. Investors should recognise the value in Arabtech and buy the stock up. The UAE Central Bank this week has reduced the Tier 1 capital requirements from banks to 7%, reversing the trend of increasing the Tier 1 capital requirements as of last year. The policy is intended to increase and stimulate lending in the UAE. However, credit conditions remain very tight, and we believe that banks will hold on to their accumulated capital at the moment to protect their balance sheet against any further rises in provisions and non-performing loans during the second half. Travco Group, which is an Egyptian travel tour company, has announced that it will soon form a partnership with a budget carrier in the GCC/MENA region. Travco has not specified who the partner will be, and we're still waiting for Air Arabia, one of our preferred picks in the UAE, to announce where its third hub will be. Therefore, there is a possibility that the tie-up between Travco is also with Air Arabia. We think that the announcement of this third hub by Air Arabia will be a key share price catalyst, and the price of Air Arabia has indeed crept up over the last week, now trading at 1.05 dirhams, still well below our price target of 1.33. Therefore, we recommend that investors should top up their holdings for share price upside. ABAR Investments, listed on the ADX, this week reported first half 09 profit numbers. Total comprehensive income was 1.7 billion dirhams. This includes 3.8 billion dirhams worth of book value gains on investments made in Atlantia and Daimler companies over the course of this year, and also includes 2.1 billion dirhams worth of losses on derivative instruments such as puts and collars relating to these investments. ABAR also sold 3 billion dirhams worth of Pearl Energy, purchased Falcon Private Banking, formerly an AIG banking asset, for 1.1 billion, and also made 4.4 billion dirhams worth of property purchases during the first half. Gauging by the sell down last week, we believe that the market has not adequately interpreted the financial statements and given too much weighting to the losses made on puts and collars derivative instruments, and not enough weighting to the fact that ABAR has around 5.4 billion dirhams in capital gains made on the investments in Daimler and Atlantia up until the 1st of September 09. That's all for corporate news this week. Ma salam and sayonara.